Hi, and welcome back to another property finance tip. So what is it this week? Well, it's a very simple way to simplify your understanding of how bridging works. So it can be a bit complex, but this is going to really simplify it for you. So keep watching. Okay, so whether you're new to property or not, you may be new to bridging. Now, as with anything, when it's new to you, it's confusing. And there are so many different aspects of bridging finance that it can quite easily be confusing. So let me simplify this right down for you this week. I'm going to say to you that pretty much every bridging loan can be divided and boxed into one or more of 5 categories. First of all, we have a purchase bridge. Secondly, we have a market value bridge. Thirdly, we have a refurb bridge. Fourth is a done-up value bridge. And fifth is a cross-collateral bridge. So there we are, 5 types of bridge, and pretty much any bridging loan that you would ever do is going to fall into at least one of those 5 boxes, if you want to call it that. Okay, so now let's drill down. So what is a purchase bridge? Let's look at that first of all. So a purchase bridge, in terms of the way they structure the loan, has a lot in common with mortgages. Now, mortgages are based on the lower of the purchase price or value. So let's say, for example, the value, and indeed the asking price could be, is 100,000. But because the seller is a bit motivated, then you've agreed with them that you're going to buy it for 80,000. So it's worth 100, but you're buying it at 80. The mortgage lender's valuer would just ignore the 100, take the lower one of 80, and the mortgage is going to be based on that. That's how mortgages work in terms of working out what value to base the mortgage on. Now, a purchase bridge is exactly the same. They'll say, right, what's the value? What's the purchase price? We'll lend on the lower of the two. So that's how a purchase bridge works. Fairly simple, really. Now let's move on to the second one. Let's move on to a market value bridge. Now, what's different about that? Well, we learned just now that mortgages and purchase bridges lend on the lower of the value or the purchase price. Now, a market value bridge lends on the lower of the market value or the asking price, whichever is the lower. So it could be on the market for, so the asking price could be 100, but it could be worth 110. So therefore they'll lend on the lower of the two. So they'll lend actually on the asking price, regardless of what you're buying it at in the main. So, but it could be that the asking price is 100, but the value is 95. So they'll lend on 95. So it's always the lower of the value or the asking price, whichever that is. So now, where is that handy? Well, if you look at some of my other videos, you'll refer to, in fact, it's the shrink the deposit one, how to shrink your deposit away less than 25%. Now, that's all about using a market value bridge. So that comes in very handy when you're buying below the asking price, because that minimizes your deposit. So check out that video for a more detailed explanation of how that can work for you. So now we're going to look at a refurb bridge. So what exactly is that? Well, a refurb bridge lends on the purchase and the refurb money too. So all you've got to worry about finding is the deposit. And typically they will lend 70 or 75% of the purchase price. So you need to put 25 or 30% down. So whereas other bridges might, other types of bridging may mean that you have to fund the refurb yourself in part or in whole, a refurb bridge means that 100% of the refurb cost will be funded. Now, how does that work exactly? So they're not going to give you the whole refurb money up front before you do the refurb, because if the maximum they would lend is 70 or 75% of the purchase price, if they gave you any more, they'd be above their maximum. So clearly that wouldn't work. So now, depending on the size of the refurb is depending on how it works. Now, let's say you've got, for argument's sake, a 30,000 refurb. So typically on the refurb bridge, how it would work is that they'd probably split them into 3 tranches of 10,000. So you'd kick it off, you'd do the first tranche of 10,000 from your own money, and then the valuer that came out to value the property originally would come back to do an inspection, look at the work you've done, sign it off, and then the bridger would release that tranche of £10,000. So you'd spent £10,000 of your own money, you've got it back, and now you can do the next phase of the refurb. So you spend that £10,000. And then the process repeats itself, valuer comes back out, inspects that proportion of the work, signs it off, you get another 10,000. And that carries on until you've got 3 tranches of £30,000, or 3 tranches of 10, which equal £30,000, and you've had 100% of the refurb funded. And then, like all bridges, you decide whether you're going to sell it or refinance it to repay the bridger. So what's the fourth one? The fourth one, as we said, is the done-up value bridge. Okay, how does that work? So this is, I'm going to give you an overview of this, but it is available in more depth on another video, which is how to fund delayed completion. The premise of this is a delayed completion bridge. So you exchange contracts, having agreed with the seller prior to that, that you can have the keys on exchange of contracts, not on completion, which is normal. You also agree with the seller that you have their permission to enter the property and to carry out a refurb work. So you would do that in between exchange and completion. Now, once the refurb is complete and you're ready to complete the purchase, the bridging lender's valuer comes out and he values what he sees, which is what? It's the done up value, because you've just done it up. So you get a value based on the done up value. And then you complete, and you can then sell or refinance as you wish. That's the done up value bridge. So now, having done the 4, we now move on to the 5th one, which is the cross collateral bridge. Now, this is used where you don't want or you can't put down the normal cash deposit that's required. So instead of cash, you use equity. And where is that equity? It's in a property that you already own. So let's look at that in 2 ways. If you own a property with no mortgage on it, or if you own a property with a low mortgage on it. So let's look at both of those. So if you're fortunate enough to own a property and it's got no mortgage on it, then you can put this up as additional security, and the bridging lender will give you 1 bridging loan against 2 properties, the one you want to buy and the one you already own, and they'll give you one loan. So the equity you've got in this property that you own without a mortgage is enough to cover the deposit for the one you want to buy. Now, depending on the comparable values of these properties, the one you want to buy and the one you own, it may even be enough to cover the refurb costs and stamp duty and interest and all those sort of things. So it's a great way to do what I call a no hard cash down deal. In other words, the only amount of cash you would need to put down is enough for a valuation and also to cover your legal fees. So that's the unencumbered version of a cross-collateral bridge. Now, maybe you're not lucky enough to own a property that has got no mortgage on it. Maybe it's got some mortgage, but it's got a low mortgage. Now, this works well in most cases if you've got a property with at least 50% equity in it. So 50% equity. So then we have bridges that do a second charge loan. So again, it's one loan against two properties, the one you're buying and the one you already own that's got a mortgage on it. So a second charge bridge sits behind or on top of the first charge mortgage with your mortgage lender. That's not disturbed. And then they lend you that money. So that's cross-collateral bridging. Now, you can use cross-collateral bridging with any of the other four. You can use it with a done-up value. You could use it with a refurb, a market value, or a purchase bridge. So the fifth one, the cross-collateral bridge, is the one that you can actually use within the others to avoid putting down a cash deposit, if that's what you want to do. So there we are. That should, I hope, simplify at least some aspects of bridging. So when you're working out which bridging you're looking at, type of bridging you're looking at, see if which one of those boxes you can put it into. Is it a purchase, a market value, a refurb, a done-up value, or a cross-collateral bridge? Okay, that's it for this week. So I hope you found that useful. And hey, if you haven't already, click this subscribe button here and also click the little bell so you get a reminder on your phone when there's a new video to watch. So have a great week. I'll see you next week.